Good afternoon, Len. I trust that you are well. Our discussion last week regarding Britannic Opportunities Limited refers. As you know, we were a bit late to get into Britannic, and I've made an inquiry at Investec regarding secondary shares that's available, and they have come back to me and given me a breakdown of what's available, and they've put something together which I'll forward on to you, which is basically their top picks of the 7 companies that have some secondary stock available. So I'm going to open that up. We'll talk through it just now. You will see on page 2 of 5, Asia Pacific is the best one, value for money at this stage. Just to give you a bit of background as to what is Asia Pacific. You're familiar with Britannic Opportunities now. Asia Pacific works on exactly the same basis. There's just a slight difference in the weighting to the underlying indices. So I'll forward this link to you as well. This is where you can keep track of what's happening with the share price of these companies on a daily basis, or if you just want to have a look at the monthly fact sheets. So let's have a look at the monthly fact sheet. And this is Asia Pacific. You will see that the inception date of this investment was the 22nd of December 2017. In other words, a year and a half ago. And the only way that it differs from Britannic Opportunities is that it has slightly different weightings to the indices. The S&P 500, which is the top 500 companies listed in America, it's got a 40% weighting. In other words, exactly the same as Britannic. 30% allocation to the top 50 companies listed in Europe. In other words, exactly the same as Britannic. Here's where the difference comes in. Britannic had a 30% allocation to the Nikkei 225. Whereas Asia Pacific only has a 15% exposure to the top 225 companies listed in Japan. And then for the other 15%, they have an exposure on the MSCI emerging markets. So what we now have to do is have a look at what was promised to the Asia Pacific shareholders just before they concluded this deal. And as they advertised a 200% participation as per the prospectus, the same as Britannic, but they actually traded at 240%. So what this basically means, if you have a look at the maximum that the investment can do, which is 159, you have to subtract the 4% that's guaranteed, because they received a guaranteed 4% as a minimum, and a maximum of 159. So if you take the guaranteed 4 off the 159, you get the 155 or 55% upside. So if we quickly have a look at that and we say, let me just move that a little bit, 55.223 divided by 2.41, it means we get an answer of 22.9. So the markets, these underlying indices here, the weighted movement, must just be 22.9 in order for the investor to get a 159 over there. And you get that by dividing the 55.23% by 2.41 basically, as the gearing is 240%. So this is from an upside perspective. From a capital guarantee perspective, the only difference is here we had an ABSA and an First Rand bond in Britannic Opportunities. Asia Pacific is linked to Investec subdebt, so they bought an Investec subdebt bond. So that's being the only difference. So if we have a look at this investment, what does it enable you? It gives you a geared upside if markets are up over the next 3.5 years, and if markets are down, you don't lose anything because your capital is guaranteed. So you can make money if there's money to be made, and you won't lose any money if markets fall or markets crash. So going back to the Investec analysis that they've done, what they've basically indicated here is, as at the 30th of June, and I've asked them just to update it for me with today's live prices, what will happen in a scenario if the markets move or fall 5%, 10%, 15, 20 or 25 at expiry. So in other words, from today over the next 3.5 years, if markets fall 25%, you will get a positive 0.82% return. In other words, none of your capital is at risk. But if the markets go up 5, 10, 15, 20, 25 to up to 40%, this is what you can expect to receive as a yield. So you can see if the market does 5 from here, you will get 5.39, as the double gearing only kicks in after 4%. So if it does 10, you will get 17. If it does 15, you will get 28. If it does 20, you will get 40. If it does 25, you'll get 51. And then you see it caps out at 54.36%. So the maximum that you can make from this investment over the next 3.5 years is 54.36%, which equates to an internal rate of return, an IRR of 13.13% in dollars, which is a very good return in dollars, seeing that US inflation is only 1.6%. So that's a very good real return. And that's along of the short. I'll also give you a phone call to discuss. I'm happy to come over to run you through the initial documentation that was issued on Asia Pacific, the same as what I did on Britannic. And Yapi Libbe is also in town next week, Thursday. Yapi is the guy that set up this business for Investec in 2000. He's still with them today, and he designs these products for them. He's also happy to meet with you and your dad if you would like. So chew on it and let me know. Thanks, Len. Keep well. Cheers. Bye.